What is capital flight in a balance of payments crisis? Imagine watching a country's money suddenly vanish, like water slipping through your fingers. That's what happens during capital flight in a balance of payments crisis. When a country faces economic trouble or political unrest, people and investors often lose confidence. They start moving their money and assets out of the country quickly to protect their wealth. This rapid outflow is called capital flight. It usually happens when the country cannot pay for its foreign trade because it spends more than it earns. This creates a balance of payments crisis, which is when a country struggles to finance its current account deficit or when foreign investments suddenly stop coming in. During these times, the country's currency can lose value fast. The central bank tries to defend the currency by using foreign currency reserves, but if too much money leaves, reserves run low. This makes it harder to keep the currency stable, often leading to a sharp devaluation or switching to a floating exchange rate. When investors see the currency falling, they get even more worried and withdraw more money, making the crisis worse. This cycle can cause the country's economy to spiral downward quickly. Many factors cause capital flight in such situations. People fear hyperinflation, which means prices rise very fast, or they worry about the currency losing value. Political instability, government policies like raising taxes or nationalizing assets also scare investors. Wealthier individuals and big companies are more able to move their assets abroad, while ordinary citizens usually can't participate as easily. Governments sometimes try to stop capital flight by imposing controls on how much money can leave the country, but these measures are hard to enforce in a globalized financial system. Looking at history, capital flight has often made balance of payments crises worse. When investors anticipate trouble, they withdraw their money early, sometimes causing the crisis to happen sooner or more severely. This withdrawal drains foreign currency reserves faster, forcing the government to intervene more aggressively. Such interventions can sometimes trigger a crisis that might have been avoided or delayed. Understanding capital flight helps explain why some countries face sudden currency collapses and economic downturns after external shocks or poor policies. It shows how investor confidence and expectations can shape a country's economic fate. Countries that want to prevent these crises need to maintain economic stability, credible policies, and enough foreign reserves. This way, they can reduce the risk of rapid outflows and protect their economy from the damaging effects of capital flight.